The recent reversal of the yen's safe haven gains from over the summer has been driven by three key factors. Firstly, there is building optimism that both the US and China would like to reach at least a temporary ceasefire when trade talks resume next week. Secondly, there is also building optimism that the risk of a no-deal Brexit will likely be delayed beyond the end of October. And then finally, there's also some optimism as well that the global central banks are now taking policy action to address those downside risks to growth going forward. And we have seen recently, particularly in the US housing market, evidence that low rates are starting to boost activity. However, the tentative improvement in global investor risk sentiment is built on shaky foundations. We still believe that risks remain tilted to the downside for the outlook for global growth. We've seen weakness so far, mainly evident in the manufacturing sector and in the Chinese and European economies. But downside risks could intensify going forward if that weakness starts to spread more into the service sector and also to the US economy. In these circumstances, the recent yen sell-off could prove short-lived, and we prefer to remain defensively positioned in emerging market and commodity-related currencies. The Fed's latest policy update disappointed more dovish expectations. They failed to provide a clear signal that at least one more rate cut is likely later this year, and were even clearer that they do not expect to cut rates at all next year. This highlights that the Fed still believes this is more of a mid-cycle adjustment, similar to during the mid-1990s, and not the start of a more aggressive rate cut cycle. It's based on their optimistic belief that the modest easing to date will prove sufficient to help keep growth above potential. However, leading indicators, including the persistent flatness of the US yield curve and the recent sharp drop in the ISM manufacturing survey, which fell to its lowest level since the global financial crisis, are signaling an increasing risk of a more abrupt slowdown in the US economy going forward. These developments, we believe, will increase pressure on the Fed to deliver another rate cut, potentially as soon as at the end of this month. We also expect the Fed to announce a resumption of balance sheet expansion at their next policy meeting to help address the recent tightening of US dollar funding conditions. The US dollar has strengthened gradually this year. The ongoing resilience of the US economy, the higher yields on offer in the US, and the ongoing shift to a more protectionist US trade policies have all favoured a stronger US dollar. In light of recent developments, we now expect US dollar strength to prove even more persistent going forward, and the dollar index could even retest the highs from at the start of 2017. US policymakers would have to push back more strongly, either through more aggressive Fed easing or by intervening directly in the FX market to trigger a more sustained reversal of dollar strength. Alternatively, market participants could become more fearful that President Trump's dollar-positive policies could be reversed ahead of next year's elections. One final point: impeachment risk has increased recently, although it hasn't yet had a material impact on market expectations.